Well, good morning, Sean. How are you doing today?
Good morning. I'm doing fine.
All right. Well, that's good. Well, we had promised and teased that we would have a little bit of a biotech segment going on today. Before we get into that, what's your take over some of the action that we've seen over the last couple days in the NASDAQ? Kind of a back and forth, tight trading. What's your overall take on what's going on?
Well, it's kind of what we talked about. It's the market is in a kind of a push-pull, tug-of-war, indecisive, whatever euphemism you want to work. I actually think it's setting up very much like prior sell-offs. So again, spring of 14, mid to late 2015. I talked a while ago that a tailwind, which is now a headwind, which was a huge headwind in late 15, early 16, was a much stronger U.S. dollar, which that's happening, and that's been happening. And anymore, the sell. Put it this way, the smartest people in the world can predict the sell-off, and they literally can be either wrong or early for a long time. But the premise that they had, and I'm not talking about me. I'm talking about lots of other people that have far more gravitas than I do. I mean, I think you asked me about Carl Icahn one time, what I thought of him, or what I thought about some of his positions. I mean, he's been prepping for a major sell-off for like 3 years. so yeah, he's one of the best investors probably of all time. So the conditions are there. They've been there for a long time. But I think what's happening now is a few things that are necessary precursors are lining up. Netflix isn't acting well. FANG's not acting well. I mean, you get 2 of the 4 FANG names arguably correcting pretty vigorously. So that's something that is. It's like everybody in the world knew it was going to happen. We just didn't know when. You have Tesla. Again, I can't say what I really think of everything going on with Tesla. To a large public audience like this, but I can tone it down and say, all I'm going to say is, hey, companies like WorldCom and Enron were at one time leading companies in their respective industries, and they both don't exist anymore. So. There's lots of weird stuff has happened over a long time, and I think just some of it's just going to have to unwind. Some of the lunacy is going to have to unwind. By the way, it's equally lunatic that stocks like Twitter and multitudes of other stocks, far cheaper than Twitter, have gotten no credit for years. So, the beauty of this market is it's probably the best market to have active longs and shorts simultaneously in a long time. I'm trying to think of the last setup, probably the last setup that was equally as profitable over time for both having longs and shorts was spring of 2014, because you had shorts work exceedingly well in multiple groups, and you also had longs that, again, neglected longs that were very good or even great companies work marvelously. Everything kind of changed. Everything kind of changed in late 15, early 2016, and the market's essentially been the same since then. And I think it's kind of setting up for a market that becomes a different market. So all that's a long-winded way of saying kind of what I think's going to happen is going to happen. I think we're going to rotate. I think value at some point will supersede growth. I think a lot of people have actually conflated growth, though. They've actually said, they've called some companies growth companies, which are actually, I guess you call them slow growth, very expensive value companies. So we'll just see what happens, but I think a lot of stuff's kind of going to rectify. I think we're going to have a rotation. It'll be similar. It'll be similar to kind of what occurred post spring of 14, what occurred post spring of 16, what occurred post spring of 2011, et cetera, et cetera. So by the way, you notice there's 3 springs in there. Maybe this whole thing still has a last gasp, and the market still fights to try to be the same market it's been until the spring of next year. We'll see. I do think you have a Fed which could overshoot. It's getting closer to overshooting. You have elections coming up in a few months, actually pretty close, 2-3 months now. You have much tougher comps for most hot stocks next year. So, it's all the same stuff we've talked about, but I think the timing is closer now than it probably was, 2 or 3 quarters ago.
All right. Well, why don't we transition into some biotechs now that we kind of have a summary of your overall tech space that you cover. And we can touch on some of the more individual names later on in the week. But since we have been talking that we're going to do a biotech call, why don't we talk about, instead of just jumping right into some of the names that you like, some of the criteria that you use to select, some of the things that you like and some of the things that you don't like in a biotech story.
Yeah, I mean, I think, there's a number of cardinal sins that most people make. And, there's some people actually sell services, pretty expensive services that are broken clock services, meaning, they make 240 calls a week and, 1/12 of them are right. And they brag about, the 3 or 4 or 5 right calls. But the most biotech, I think here's what I think of conventional thinking. Most conventional thinking, and by the way, this is just like tech. They tend to chase a story. They tend to buy a hot chart. And by the way, the single worst area to try to use a chart or technicals to justify purchases and sales would be biotech, because ultimately biotech is catalyst driven. It's driven by news. Now, sometimes the news actually creates a catalyst, which the catalyst serves to be the opposite of, in other words, the stock moves opposite of the news, or the interpretation of the news. But it's still a catalyst. So, but I would say most biotech traders, and especially the guys that they're boom bust biotech traders, they actually never really make money. They might make money for periods of time, then they bust, and then they have a boom and they bust. And that's an unprofitable trader long term. It's a losing trader long term. And so, but they tend to chase news instead of chasing quality. So if you remember something like a Juno, when I really liked it, I didn't like Juno at highs. I liked Juno close to the lows. Some of my prices ended up not being the lows. But there was a potential pipeline there and an M&A story that was really compelling, which I didn't like at 80, but I really liked at sort of 35 and lower. And I think at 2022 was ultimately kind of the lowest. I think I was able to buy that. Sarepta was another one. Now, Sarepta meets one of my criteria, and this is not something I necessarily look for, but this is a setup I like. Again, this is exactly what the bulk of biotech people don't like. So I like a company that has an approved drug, and what happens is it gets wrecked. So the hype, and so the people that chase the hype on the potential for a drug being approved generally buy stocks far, far higher. Sometimes you get a last gasp spike. Oftentimes you don't, though. But let's say you do get a spike. It's very short-lived. And then what happens is realism hits. And the realism is that, okay, so the drug is approved, now what? And generally, post-sales after approvals almost never meet up to expectations. They're usually worse than expectations. But let's examine the condition of the company. What has the company just done that it didn't have before? It actually has had an approval. It's got real revenues, and it's got better sources of funding now because they have something they can bank or they can tie funding to, i.e. the future sales of a drug that was approved. Also, no, this is something I can't prove, but this is something that's worked really well for me. Generally, once a company gets an approval, it seems to be a lot easier for them to get more approvals. And a lot of times, it's just because you get approval on one drug or a treatment, generally that treatment or drug is applicable to more than just one thing. So it's pretty rare that something gets an approval and it only works in one really weird discrete area. Usually an approval leads to more approvals. So and so we could talk about something like ACAD right now, because sometimes it's just easier to talk about an example. Mm-hmm. So ACADS is a perfect case study. So you had initial hype on this name, probably post IPO. I don't know what happened, if there was bad news or it was just dull trading that, took the stock from, I don't know, whatever, the $6-7 to like a penny stock. And then you had enough good news and hope that the stock became a monster. And this was all pre-approval. And then a funny thing has happened to ACAD since their approval. They've had 2 major sell-offs. They're in the midst of their second major sell-off now. But the first major sell-off I was able to take advantage of and made quite a bit of money, almost doubled my money. So the stock went from like almost 50 to 16 back to 40s. So I was a buyer. I don't know if I bought the lows, but I was buying some, I think 18 to 21, if not lower. And then as more sales have come in, they've sort of been disappointing. And the stock is actually trading. I mean, this stock has traded far, far cheaper than it was pre-approval. So, to me, this is a really good example of, I think they'll get more approvals just because odds line up. They'll get more. They're treating a holy grail area, which is memory loss, memory dysfunction, neuromuscular issue, wasting diseases, things like that. And they have a very, very small indication approval right now. But this is classic. This is classic that you just, there's probably not a lot of institutional support. It's probably easy to rate it. Good news is conflated as bad news. We go on and on and on. And again, I have no idea when this is going to. My guess is this will probably work when there's a turn in sales versus expectations. So the analysts who like this name probably had sales estimates which were a little too aggressive, too high, too pumped up. Well, they were wrong. That's hurt the company's stock price. Or you get another approval. I mean, you get another approval, this thing could go crazy. Or you get a buyout. So another stock it did very well with was a company called Relepsa. And Relepsa was just like this. Relepsa, I had zero interest in Relepsa pre-approval. It was a hot stock. I don't even know where it traded. The stock, I can't pull up the chart anymore. It doesn't exist. I want to say it was like 48 to 60 is where everybody was all hyped up on it. They got an approval, and the thing literally immediately went to 20. I think it got cut by 2/3. I started liking it at 20. I think it might have gone to 12 or 13 or 16 or something. Added more to it, and then I had 2 trades on it, kind of the same thing. I had one trade where things just got a little better. I don't think they quite doubled. They went up very nicely though, like 50, 80%. And then kind of the bears started beating on them again. And then lo and behold, what happened? They got bought out. And I actually think Relepsa ended up selling too cheaply, by the way. But sometimes these guys kind of have to, because they get in a situation where it just becomes very hard for them to exist, meaning they're at the point where they either sell or they have to do some incredibly dilutive financings to keep operating. And again, I don't want to be a conspiracy theorist, but maybe sometimes people push them to the point where they almost have to take a deal, so therefore somebody ends up getting a good deal. I mean, stranger things have happened, right? But anyway, so Relepsa was a beautiful scenario. Sarepta was another one. Sarepta was another name that, again, wasn't very interested in the name pre-approval. Post-approval, we could probably pull that chart up, SRPT. Post-approval, I can't remember how much they took out of it, but I would say it definitely declined 70%. And I was a buyer of this one. I sold this one way too early, by the way, but I caught a big move in it. Now, this one's, I think, way overhyped again. I think it's way overhyped on theories that they're going to get more indications for and more approvals. I don't know if they will or not, but my guess is even if they do, they'll probably sell the stock off a lot again on whenever this gets an approval again. And if it drops enough, I might get interested in this name. But anyway, bottom line is Sarepta. But then this isn't the only way I do buy it. I mean, Juno never had an approval, and I like that stock. Other stocks have many approvals, and I like them. I didn't buy Celgene, but I was recommending Celgene. Probably, was it 20 points lower or 15 points lower or something? ago, and I mean, sometimes just high quality companies get beat up and sold enough. But at the end of the day, again, just don't do what most people do, because the masses lose money on biotech. This is a very tough space. I like tough spaces. I like spaces where the masses tend to lose and I tend to win. And it's almost set up that way. You just have to just not do what the masses do in these spaces, and then you'll be pretty successful. I'm trying to think if there was another really good example of this sort of the Sarepta, ACAD, Relepsa. Was it Portola? I don't know. I can't remember the name off the top of my head right now, but it was exactly the same deal. I basically bought it post-approval after a massive decline, and it ended up working out very, very, very nicely. I mean, I have a long history in biotech. I mean, there's been a lot of companies that don't even exist anymore that I honestly can't remember the names of. The one thing I tend to do, whatever my methodology is, I tend to be in longs in the biotech space that end up getting bought out. So a lot of the biotech names, especially in the cancer area. God, the name I just can't. AbbVie was a company that bought. Oh, Pharmacyclics. That was the company I was trying to think of. Again, we can't pull up this chart anymore, but Pharmacyclics had arguably one of the best drugs ever to have been created. And there again, I'm not really sure why Pharmacyclics sold themselves, to be honest. They got a very nice price, but I kind of ultimately think that company would have been bigger had they stayed solo, and they had no funding issues. But anyway, Pharmacyclics sold to AbbVie. That was a huge winner for me. And again, I could have been on that name pre-approval. Frankly, I kind of missed it. I'd followed that company for years, but it got super, super hyped up. I want to say it got cut in half or more upon their approval. And by the way, they never really even missed numbers. Their numbers were always very good. But it was something like a $200 stock that went to 100. I bought it around there. Did well with it. Numbers were great. I literally believe they had 48 trials running, meaning they could have been approved for 48 more indications, which AbbVie will probably ride the wave of those indications for many, many years to come. But anyway, Pharmacyclics got bought out. So, and they probably got bought out for 2 to 2.5 times kind of that post-approval low price. But anyway, that was the one I was trying to remember. And AbbVie, I mean, I don't. That's more of a bigger name, but it's taken a big shot lower too. I could make a case for this stock. I like Celgene better. I probably like Gilead better. But anyway, that's kind of a snapshot of my view in the space in 10 minutes or less. Don't do what the masses do. Don't chase charts. Don't chase the hope of approvals. Don't be afraid of a bad chart if you have an existing approval, things like that. And those are the things I think. And cardinal rule number 5, which maybe should be number 1, is do not subscribe to the peddlers of biotech services, because they will have you chasing every headline. Oh, hey, ASCO's coming. Look at hey, there's an FDA decision on this drug. We're selling puts here. We're buying calls there. Blah 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 blah. I mean, yeah. I mean, you might as well just send money to me and I'll burn it in a fire. It would probably have a better return. So yeah, I haven't seen too many of the traditional services. If there's one out there, maybe there is a good one. But look at like Baker Brothers, kind of famous in the biotech space. There's a few other good. I think the Fidelity Science and Biotechnology portfolio is a very noted outperformer long term. But I look at Baker Brothers. I look at their stuff. If you look at what they do, they kind of do what I do. They build positions over time. They tend to buy stuff cheap. They don't chase. They like names post-approval. I mean, they speculate. They are involved in names pre-approvals too. But I don't think, I can almost guarantee you that Baker Brothers probably don't care what a chart on a biotech stock looks like. They probably care about the management team, the science, how's the balance sheet. How's their funding? How's access to further funding if they need it? Things like that. Because again, these stocks are ultimately going to go the way of revenues and cash flow. If they never find revenues and they never generate cash flow, they go zero. If they create drugs that get approved, those drugs create revenues. Those revenues eventually create cash flow. There you go. Then they generally track with either revenue or cash flow growth over time. Is usually what happens. And the beauty of biotechs is, you literally can have a company that goes from zero revenues to $1 billion in revenues in 2 years. I mean, you get a good enough drug approved, or a drug that gets approved for multiple indications, and you go from not really having a viable business financially to having an incredibly viable business. Like I said, just the one indication on that pharmaceutics drug, by the way, I believe they were doing something like 800, 900 million a year in sales. And that's why I still to this day am surprised that they sold. Because let's just say a quarter of those 48 indications were to come through, and those indications were even 25 to 30 or 40% as successful as their core drug. I mean, you're talking about a $10 billion per annum revenue company. And I guarantee you they didn't sell. They didn't sell for 80 or 90 or 100 billion bucks. But so that's the other thing too. Don't take a trade. I guess this would be cardinal rule number 6. I see a lot of people get up 2 points on a $20 stock and take a trade. If you're investing in biotech, the odds of you being down 20, 30, 40, or even 50% on a successful investment is actually quite high. So in other words, if you have a chance of having a 30 to a 50% drawdown if nothing's wrong, and yet you take 10% winners, you got your math backwards, right? So because you probably weren't going to sell the name if you're down 30 or 40%. So the only way that the trade's going to work is you got to make 1 or 2 or 3x the upside. But I see. I mean, that's just the thing I see a lot of people do. A lot of people will. I guess these are the people who should use stops. So if you're willing to ride something down 30 or 40%, yet you're going to sell it the first time you make 7 or 8 or 10 or 12%, it's going to be hard to make money. So theoretically, then if you have a stop of 3 or 4 or 7%, if you're going to cut every winner at 10%, you probably should have stops. So you have to know yourself. But anyway, I see people do that all the time. I got friends of mine. I have people I consult that bought June on my recommendation that sold it on a 4-point gain. When that thing was 65, 70, 80, I don't even know wherever I think they might have got bought out for 80. That was a bad trade. So if you're buying something that has the risk of a biotech and you take a 10 or a 20% winner, you basically are doing the market math backwards, in my view. So I'll stop there, and then you can ask me or whatever you want.
Sure. I'm curious as to what are your parameters in a stock. Let's just use ACAD or whatever, in which you've got a big rise in the name, and then you're looking for a pullback. At what point are you getting involved if it's not about the chart? What is the criteria that would set you up to find and establish a new long position in a name?
Well, if it's had a big rise, first of all, I'm probably going to ignore it, unless it's had a big rise.
I'm talking about specifically on the pullback, because you suggested that you wait for a big rise and then for it to break down, but yet nothing's technically wrong with the company. At what point do you decide, hey, this is the opportunity that I've been looking for in a given name?
Yeah, I wouldn't say there's really any particular science. I mean, what probably starts attracting me at sort of an initial screen would be something like, okay, all of a sudden now this stock is really cheap on like revenue metrics versus other companies that have revenue production. There's a lot of them. I mean, a lot of this is honestly, biotech is kind of one of these areas. Again, my first criteria is just don't do what everybody else is doing, and then kind of sift through the weeds and screen and find stuff. But maybe a good example is something like Intercept. Intercept already has, they have revenues. They have for sure one approval, if not more. That was another one that got really, really beaten up post approval. But like if modeling that out. Now this one was a little more speculative, so the price to sales ratio is higher. But when I got interested in Intercept, just as an example, it was only trading about 5 times, maybe, yeah, but I think 5, maybe 6 times forward sales. So just as an example, a stodgy old, how many, I don't even know how many drugs they have approved. Something like, an Amgen or a Biogen trades at 5 times forward sales. So here's Intercept with you don't want to call it infinite growth because but by the way, they probably have a high probability of multiple indications as well. But just on current growth of their existing pipeline approvals, they're kind of running at a 50-60% growth rate on revenues. And so when I think, didn't I put down my focus list like $55 to $60? It was might have been 51. I'd have to go back and look. But let's just say it was 60 or lower for sure. So at that price, you were talking about 5-6 times sales with a growth rate of like say 50 to 60%. And again, I'm not even I'm figuring I got a call option on anything they ever get approved again, because I'm buying their existing revenue stream at 5 times sales. That's what I would pay for Amgen. And guess what? Amgen has no growth. They're basically a zero growth company. Now, I think Amgen will probably produce growth again in the future, but I'm just talking about next year's growth. Another one, Biogen, on estimates, they don't really have, same thing, 3, 4, 5% growth, something like that. Same thing, they're 5 times forward sales. So, I mean, there's lots of things I can look at. That's one thing I kind of look at. But I'm going to say this, there's certain people kind of have a knack for biotech, and certain people don't. And there's sometimes I can't really explain what attracts me, but whatever I do generally doesn't work in the short term, but usually to almost always works in the long term. I've had very, very few long-term biotech losers. I've had a few, because we all do. I mean, if you're going to transact in hundreds of companies per year, you're going to have a few losers. But there's not that many biotechs I've gotten hugely killed on. I'm trying to even recall the last one. I mean, one that I almost got killed on ended up making a really big score. This is Kayla. Yeah, you could pull this CALA. I had literally written this one off. So this is, and by the way, I did everything right. I did everything right on this name. I just thought, okay, hey, their ship's never going to come in, and yet they got some really, really good data. Kind of early mid 2017, and I got bailed out on it. I sold this around 10, and it did go higher, but yeah, it's $4 again today. But that was a name. Okay, but the one thing I didn't say, when I start sniffing around on something, if I'm buying these cheap, which again I never buy a biotech hot or expensive, so I always buy them cheap. But I usually look at their existing balance sheet. So even though they're a cash burn situation, I think I was buying Kayla when they basically were selling it like 1 times cash. Now it's cash that's not going to last because they're burning cash, but at least you have a cushion. At least you either have you're buying at a cheap multiple of cash, even though that cash is declining over time. But what does that do? That gives you time. It's how I kind of line it up. It's like, okay, usually got like a 2-year window that they got to hit something in 2 years. Because that was exactly Kayla's situation. They had 8 quarters of cash. So assuming they got no new funding at the time I was buying them, and that was one hated name, by the way. I mean, and hey, I was down 50% on that. I thought it was dirt cheap at $4.50, and it went to like 2 something. But when I bought them, they had 8 quarters of cash. When I got my exit on them, they probably had 3 quarters of cash left. And now I think they have quite a bit of cash again, because I think they've raised money again. I'm sort of looking at that name again, by the way. I tend to know the management teams. The people that are at Kayla and leading Kayla, they have had at least 2, if not 3, successful biotech exits before. And I was actually in one of their companies before. I can't remember the name. It's one of those names I was trying to remember. It was a cancer drug, the cancer company that got bought out by somebody else. So they have a good history, good management team. I think they're pretty well funded again. This is CALA. But this is one I thought I was going to lose money. I did. I thought I was dead. I thought I was buried because I think I only had like 3/4 of time left on it. And I'm like, okay, well, this is going to be one that's not going to work. And I got bailed out. But had I not bought that where I bought it, had I bought it at $15, I wouldn't have made any money, right? Or had I bought it when into the hype of good news, I would have lost money. So, this is one I kind of waited for everything to look pretty bad. And then a funny thing happened on this one, by the way. This is another good. They actually had plenty of good news. So from the time I bought them, there were a couple times I could have sold it at a decent gain too. From the time I bought them, they had good news, and the stock kept going down. And that's another thing that can happen many times, is that once things get in this distress trend, you gotta be tougher than the algos because nothing will shake people out of a stock quicker than when they get good news and the price still keeps declining. People are like, oh, there must be something wrong that I don't know. Well, maybe not. Maybe there's just people puking up shares because they don't trust the story. They don't have the belief in themselves that they have done good research and they're right and they're going to get paid off. And then but that was it for me. Once I saw the good news, I knew I was okay. I didn't know how much money I would make, but once that good news came in, I knew I was going to be okay on that name. And that one I kind of got lucky on. I probably gave that one more rope than I give most names. I mean, like I say, if I were to compare ACAD to this, it's almost not comparable because Kayla doesn't have an approval yet. There's still a ways. I think they went from phase 1 to phase 2. They might have something in phase 3. Again, I knew them a lot better in 2.5 years ago. I could talk more intelligently about their science and things like that. But the bottom line is, at the end of the day, balance sheets do matter, cash flow matters, and even on a spec biotech, I look at the balance sheet for sure. And if they can have all the hype and all the hope in the world, but if the balance sheet looks distressed, all that tells me is, hey, they're going to do a funding. It's probably going to be highly dilutive, and there are probably people trying to pump it up to get a funding done, and then they're going to kill it. Anyway, go on with any other questions you had. But I'm telling you, there is a lot of learning. Just if somebody were just to go just study Kayla, it'd be interesting just to see how long that stock took to really go up a lot from the time they had good news. It was pretty interesting. In fact, I want to say it was like the 3rd or 4th piece of good news that finally created that big gap that they had from like 470 to 10, I think. And they had plenty of good news before that gap. It was just kind of a weird oddity that the stock went up when it did versus a prior period of time.
All right, so you mentioned Kayla as one of the ones that you're sniffing around as a potential buy. What are some other opportunities that you're focusing in on in the biotech space?
They're pretty much names I've talked about. I mean, ACAD. So people who are new to briefing probably don't remember that I nailed this trade like 1 or 2 times before. But I've sort of been wrong on it near term. Again, I don't really think there's anything wrong with the company. A lot of biotechs have been trading like this. A lot of biotechs have had plenty of good news and they keep going down. I think there's less liquidity in the market right now than people think. And when there's not much liquidity, biotechs have a very hard time, especially small and mid-cap biotechs. But I think that I don't know. I like this name a lot. Again, I'm really not worried about it at all. The question is, do I break a rule? Well, one of my personal rules is I just never buy any biotech very big. Because one, you don't need to be big in them. Because if they really work, you don't make 20%, you make 100 to 200%. So you don't need a big stake to make quite a bit of money. Secondly, they rank the probability of loss is high. So, I'm not going to put a ton of money in any specific name where the probability of loss is high. And I'd rather have enough money to have sort of a few of them as opposed to just kind of banking on one or two. But yeah, I think it's, I like that name a lot. And I'm, kind of surprised it's where it is. But if you had asked me, hey, was I surprised that Twitter went to 13 to 14? Absolutely. Was I surprised Nutanix went to 15? Hell yeah. Was I surprised Apple went to 92 just a year and a half ago? Sure. So, the lows always kind of surprise me, just like the highs on hot hype stocks surprise me. But I don't really think there's much I have to do on ACAD except just give them time. Honestly, unless something happens and some science occurs or something to where their current approval starts failing, I don't really have any worry on this because I think the current approval is going to get better. It actually has been approved for another pill form. I think they'll get multiple approvals. They have a pretty good pipeline. So, this is almost a case in point where they have just as good, if not a better pipeline than they've ever had. Yet look at where the stock traded before when they had no approval at all. So, it's sort of the argument on it's not even an argument. It's the good point that I've made, other people have made. If Tesla starts making $1 a year in earnings, what do you value Tesla at? Do you value them at 285 to 400 times earnings? And do you give Tesla a 400 PE? You probably don't. So once Tesla has earnings, the odds of the stock dropping a lot are probably pretty high because they're not going to go from negative earnings to $28 or $30 or $40 a share in earnings per year. So same thing kind of. If you look at ACAD, it's like, well, wait, you're valuing ACAD all the way up to 35. This stock comfortably traded between 20 and 40 for almost let's see, 1, 2, 3, basically a 4-year period of time. So they have the same pipeline they always did. In fact, the pipeline's better because they have 2 approvals. And again, once you have approvals, the odds of more are higher. They have all the same science they had before too. So again, this is just the kind of the lunacy of how stocks trade. And enough spent. I've talked about Agio a lot. That's AGIO. This one would have to come down a lot. I recommended this one. It was cheaper. I'll just rattle through a few names. Another name I'm kind of sniffing around is this ARDX. Now, same thing. They have an approval. Look at this stock. This stock was a $20 to a $30 stock plus pre-approval. Okay, so it's 4 now? And the approval's gone fine. And again, I just see this all the time in the biotech space. Bellicom's another name I'm in. This is pure spec, pure approval. This is sort of a cheapy bluebird type play. That kind of science.
What's that ticker on that one?
Blue.
No, not blue.
I'm sorry. BLCM.
BLCM, got it.
Yeah, it's kind of a poor man's blue. By the way, another name. Now, I think this was before my experience, before I joined you guys. I had a company called Unicure, Qure. They were a poor man's bluebird as well. I hit this one pretty good, although it's probably trading double where I sold it, by the way. I don't know if I've ever mentioned this one on. I may have, because I may have disclosed this as a biotech long a while ago. I've been out of this name probably, I don't know, since 20 or 22 or something, maybe 25. But they were a poor man's bluebird that I hit pretty good on. But let me just continue some other names. I don't know. I still think, Intercept has basically gone to my price target. But I publicly have said that my price target was almost like hyper conservative. So I think that stock's up like 80% since I added it to my focus list. I honestly don't know how high Intercept can go. There again, this if you pull up a chart of this, Okay, so pre-approval of anything, this thing traded as high as 500. In fact, same thing. Okay, so for 1, 2, 3, so for 3 years, this thing traded comfortably north of 150. Again, that was all on the fact that that the pipeline was so good it deserved that multiple. Well, they get an approval, and what did it do? It went to 49.50. so now it's doubled. But again, the pipeline is just as good as it ever was, if not better. And now they have sales, and now they have revenues, and now they have better funding. And I don't know. I mean, this thing could be a monster. So that's the whole thing too. Is with some of these, you kind of have to give them a fair amount of room. If you get too in the weeds and trying to dissect the multiple and overly predict, because I mean, okay, what if Intercept goes from 200 million in revenue to 5 billion? Then what it's trading for today makes 0 sense, right? So, but it was almost like people did buy, people paid $200 and $300 and $400 a share for the stock before. So what were they thinking? Now, were they just trading it? No. I mean, there were probably some institutional investors that paid at least $200 to $250. My guess is they were thinking that they were going to produce 2 or 3 or 4 or 5 billion a year in revenues at some point. So if it does that, the current market cap of 3 billion is paltry. You give them 10x multiple on 3 billion a year in revenue, you got a $30 billion biotech company. So I don't really know where this one could go. I still like this name a lot. Let me look at a couple more. I mean, I never gave up on Endo. I got a little bit of heat from a few people on Endo, which, hey, that's fine. Criticize me all you want. And when I'm wrong, I'm wrong. I take the heat. But I never sold a share of Endo. And look what Endo's done. Now, Endo's not really a biotech. They're more of an established pharma. But they do have some biotech research and some. I think that I would say Endo has a better pipeline than a lot of like slow growth pharmacy companies.
Where were you getting involved in this one?
Pardon?
Where were you getting involved in Endo?
My cost is probably like 9 to 12, something like that. Might have bought a little more lower. But I thought this thing was just like, I literally thought it hit a landmark bottom. I think at 1250. And for a time, I think I thought I was right. That was one of those ones. Remember where I said like I have a pattern? Generally, when a stock starts going up right after I buy it, it's usually not a good sign. And in Endo's case, it wasn't. I could have taken an exit. I didn't. Ended up going back below. But yeah, 1250, I really liked it. I think 9, I really liked it again. I don't think I added to it below 8 or 9. But by the way, that's not necessarily the worst thing to do. It's better to stick with a name because you're comfortable with the amount you have and let it work than get too much of it and be forced out of it, right? If I had piled in 8 different times, then at 650, I would have been in such massive pain, I probably would have had to unload half my position at a loss. I was never forced to do anything on Endo because I didn't have much of it to hurt me. So therefore, when it went to $5 or $6, I'm not saying I like that stocks that I like drop 30 or 40 or 50% from where my high cost basis is, but it doesn't. Honestly, it doesn't. I don't lose any sleep over it. So I still have my whole Endo position. I still think this thing could go up a ton. I mean, this thing makes no sense. I mean, if you were to value Endo on any sort of just normal EPS metrics, I mean, you're talking about a company that could do, I don't know, $2.50 to $4 a share in annual earnings. It's got a very healthy revenue pipeline. There's some worries about some lawsuits, but put it this way, they're not being valued on any future pipeline at all. They're being valued on fear. So, this is a very, very cheap stock. So again, I don't really know how high this one could. I mean, this was a fundamentally cheap stock at like $50 a few years ago. Look where it went. So I remember liking this stock. I want to say in like 2011, 2012. I'm just guesstimating it was a $25 stock around then. Very cheap stock back then, and they did fine. They did fine for a lot of years. So just this became, I mean, this thing kind of became a crazy trade off of VRX. It's almost like the fears of VRX overly spilled into this name. And, you know, hey, it's tripled off lows. So now it's not hurting me anymore. Now I'm in a position of strength. And, you know, now maybe it'll be easier to buy on dips or something. I don't know. I don't know if I really ever add to it. I don't need to. I mean, that's the other thing. Just because a stock is going up or doing well, you know, I don't need to add to it. I got plenty of names I'm trading. I got plenty of names I'm working. I don't need to add to every one I think is cheap. So, but yeah, that's an interesting name. Here's one that's probably a little more sexy. DVAX, D-V-A-X, DVAX Tech, or Dynavax is their official name. Very interesting company, good technology. They had some very good news, which spiked the stock crazy. I think I posted a trade on this on the way up. I think I bought this on good news because I felt that even though it popped big, it was still very, very cheap. I'd have to go back and look. I basically know I posted commentary on this name. And I bought this one higher. And the reason I did is because even if the pop off of lows, as big as it was percentage-wise, it was still trading at a very, very cheap multiple of like what given the balance sheet strength and things like that. So I don't believe they have any approvals or anything. I think they've just got good news on pipeline and stuff like that. But I mean, look, that's had a huge pullback again. I mean, it went all the way to 24 off of 4, and now it's dropped 50%. So I'm kind of sniffing around that one, looking at that. Another long I like, and this one is just kind of a weird trader, is Denali. Denali, I don't know if I'm going to end up having the success I had on Juno. But the stock that most, if I could, you know, I always try to find parallels and things. The stock that most reminds me of Juno, of any stock that exists now, would be this name. So what was Juno? Juno was a hype IPO. It had pretty good news, traded okay, but really kind of struggled. Aside from sort of the first initial IPO pop, there was basically a net distribution effect on Juno. And then they had bad news, and they really, really crushed it. But Juno gave plenty of trading opportunities, and Juno ended up being a spectacular long over time. They ended up getting bought out. Denali has a similar feel to me as Juno. You know, not saying their science is the same, not saying the potential is the same, but it just this again. Sometimes this is art and feel over anything. But I mean, here are the factual things I like about Juno or about Denali. I'm not worried about their funding because they just had an IPO. They're sitting on a very nice chunk of cash. They're very early in a lot of their stuff. So my guess is that the odds of having good news versus bad news are probably higher because the early phase type stuff tends to be easier to pass muster than the hardest is phase 3, and you know that's the hardest stuff. So most of these guys, most of their stuff is phase 1, phase 2. So it's easier to pass muster and have good news. By the way, I think the intercept highs were all on positive phase 1, phase 2 type results, which everybody got all nuts on. And that's why intercept went so high. Bluebird's another one, had very, very positive phase 1, phase 2 type stuff. Very, very low patient counts, maybe even animal patient counts, by the way. So small sample, great news, but on an extremely small sample, you know, the rubber meets the road in phase 3 when you're actually testing human trials on large enough patient base. So the bottom line is Denali's pretty interesting. Denali kind of sets up, I like it because, again, I think it's just kind of being sold because they can. I don't, in fact, I think most of the news Denali's produced to this point has been good. I don't really remember them having a bad release or negative news. I think it's all been pretty positive. Again, I just think they're kind of caught in a tough time for biotech, especially spec biotech. So that would probably be the one I'm most interested in. I think I posted some additional buys in this recently. So the bottom line is, you know, there's plenty of names, but right now, aside from Celgene, I still think Celgene's a home run. I think if the patient investor who likes high quality stuff, Celgene is basically like Qualcomm. It's a super good company with super good fundamentals, which should not be selling as cheaply as it does, but the market sometimes gives us extraordinary opportunities. I think Celgene is one of those opportunities for people that like safe, stodgy, maybe slower moving. But hey, you know, if Celgene were to go up 80 points, that's not exactly boring. And it could easily do something like that. Celgene's probably also the best, in like you know, I've called Google one of the best tech investors. Celgene's probably one of the best biotech investors, period. So part of the reason that the company is where they are, they've done such an exceedingly good job at investing in other companies. So I think those investments will pay off. I think their current pipeline will pay off. I think they'll make plenty of new drug discoveries. And between all that, you add it all up, Celgene's an incredible opportunity for people like safer plays. Pretty much all the stuff we mentioned is pretty much hyper speculative, right? So I'd be, you know, except ACAD. I mean, ACAD's got a current approval. But you know, the Denali's, the DVAXs, the Bellacoms, those kind of names are feast or famine. You know, the risk of loss is high, but if I hit it, I'm looking at, you know, at least, I mean, minimum return on these is 2-bagger if I'm right. And it could be way more. Could be way more than 2-bagger. But yeah, that's it. I mean, we could talk for a lot longer. Not to get too in the weeds, but you know, I just look at these. I look at the science. I look at what people say. But you know, I kind of look at sentiment, and I kind of like these things when other people don't like. There was so much positive commentary and so many people talking about buying DVAC stock literally at every one of their high points. So in 2012-13, I remember everybody being all hyped up on it, you know, at 35 to 50. Well, what happened? It got cut by 4. And then everybody was all hyped up again, 25, 30 a few years ago. What happened? Went from 30 to 3. And same thing, you know, probably the same guys that were hyping it up in 2012 and 2015 hyped it up a few months ago, you know, at $24. And, well, it's 12. So again, I'm not saying it can't go to 4 again, but they do have better data and better things than they had at 4. I mean, they've had sufficiently good news to pop the stock off the floor and raise some money. If I'm not mistaken, too, I think, here, let me look. I think DVAX has a pretty darn good balance sheet again. And that was part of the reason I was able to buy. Yeah, they do. They're it's not great, but they have sufficient funding for a while. And then also with the good news, the odds of them getting more funding are pretty high. But hey, they've just dropped 50%. I mean, if you're going to take a shot, it's a far better shot at 1250 than it was at 2250. I mean, sometimes you just got to kind of want. You can add all the complexity you want, but at the end of the day, is there a good opportunity you can take advantage of, which you don't have to think too hard about? And I'd much rather buy DVAX at 1250 than 2250 if I'm going to take a small shot at it.
All right, so I have one listener question, and this one would like to know if you have any thoughts on a company called Immune Therapeutics. AIMT is the ticker. It is a peanut allergy
doesn't ring a bell. No, and the other thing I do too, I don't try. This is another thing the biotech services, they try to put news up on tons and tons and tons of companies. And to me, that's dumb. I mean, you once you find a few good ones, just place your bets on the few good ones and go with it. Basically, the more names you involve in this space, the higher the risk of loss, because there's so many failures in this space. So it's once you find a few good ones, it's better to focus on those. And again, since I'm not going to put much money in the space anyway, you know, once I've allocated my money to a few names, I'm good. Because I'm not going to keep piling money into more and more and more names with high risk of loss. It doesn't make any sense. So yeah, no, that's not one. I don't even think I know the symbol, by the way, on that one. I do know a lot of their symbols. I've seen a lot of these things trade. But yeah, I don't even know. I don't even think I know that symbol. I did want to bring up Tesaro. So Tesaro is a name that I knew about it, but I didn't really. A reader question kind of clued me into it. And this is not to say anything mean to the reader. I think the reader was asking me about it at 45. And to be honest, the chart kind of looked interesting at 45, which is why I always say don't buy a biotech on a chart. Now, other people probably love this chart at 100, 120, 140, 180. I'm sure the bulls loved that chart at 180, thought it was going higher, but you know that was a miserable. Put it this way, it'd be better to buy this thing at 45 than 180. So that's a way better buy. But 45, you know, I don't know. I mean, I keep looking at this name. Probably the biggest problem I have with this name, I just haven't spent the time to dig into it to basically put my view on, hey, is this a name I can put my recommendation on and put my own money in? I don't think I've looked at it enough. Although, yeah, to be honest, the more I look at it, the more interested I am. I like their area. The pipeline seems okay for where they have it. But, you know, I mean, this is just, this could be a textbook biotech name too. I mean, really. I mean, look at the amount of hype it took to get that thing to where they got it to. And then look at where the stock's trading now. So, again, I'll say this. If you like the stock, it's a far better buy at 28 than it was at 180. I mean, it's really that simple. So if you're going to take a shot at it, this is probably not a bad spot to take a shot. I'm not putting my own money into it yet. I don't feel like I have enough. I can talk intelligently about it yet. But it is sort of interesting. I mean, it's a name I'm definitely working on and researching. I'll put it that way. I wouldn't short it.
Yeah, that would almost imply that the company would go out of business at the way it's the way this chart is looking if you were to short it. Yeah, so I don't suspect that you know that would be in the cards. I think that this is probably a really good chart to have the listeners take a snapshot of as a I guess as a template of what you look for without having the fundamentals and having the fundamentals available. But if you could pull up whatever service you use at home, a fundamental, take a look at Tesaro or ACAD or what would be another one? DVAX, ENDP too.
Denali's early though. Denali's early. It's the chart. By the way, I'm not saying. I mean, do I personally use my own charts to help me with biotech? Absolutely, because I look at a biotech chart differently than I look at other things. I have systems. I think I told you guys. I mean, I had 3 programmers do a year or two of work for me on my own chart calibrations. So I basically created my own proprietary technical analysis system. I've been using it for a long time, and maybe someday I'll market it or sell it. But right now, I just use it for myself. But you know, you can use charts for biotechs, but you can't use them the same way everybody else uses charts. In other words, hey, you could have a CMT, but if you're not an expert in biotech and you don't know the science, and or you haven't specialized in the technicals in this space, you know, I mean, things like 50 days and 200 days and MACDs and blah 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 blah, it's pretty meaningless. I mean, these things break on news. They just do. They break on. Now, a chart might help you. I mean, you know what a chart's going to do for me? It's going to at least tell me where. I use a lot of chart in conjunctions with sentiment. In other words, okay, you look at Tesaro's chart. I mean, this is a fascinating study in human psychology. But you can't tell me there's any positive sentiment on Tesaro now. I mean, that's what you could. I mean, we could talk about maybe a potential kind of maybe a double bottom there. We could talk about you know, by the way, there was a head and shoulders pattern that ended up working very well on this chart. So I mean, you can make arguments that there were chart patterns that actually worked on this. By the way, one of the ones that worked really well, once that thing broke an uptrend line, the ensuing downside was vicious. I mean, it was just absolutely vicious. But the single best thing I like now, at least, hey, the sentiment is so clearly negative on this thing. Look where it's trading. Now I might point you to something like you know, some EMAs. Like this might be one to kind of watch the interplay of 5 and 10 and 20 day EMAs. And if this thing could kind of trade above like the 10 and 20 EMA for an extended period of time, maybe it's finally fully washed out. And maybe it's flushed all the people who had all that hope and dreams and optimism at 100 and 120 and 160 and 180, and maybe they're all gone. And so maybe all the new people that are into sorrow can have a more a more durable investment perspective on the name. The one thing I'm going to do, I'm going to see who the institutional ownership of this name is. That's one thing I'm going to do, because this is interesting. This thing, I will say this: whatever reader turned me on to this, I have been interested in this name ever since I got the question. I'll say that, and that's probably a good sign for it.
All right. So if you could just summarize in one or two sentences how your advice on trading biotechs, what would that be?
Well, avoid the deadly sins, which I kind of covered earlier, which the main ones are, don't buy a hot chart, don't get overly dependent on technicals, don't chase news, especially news that's being perpetrated and put out by people that probably have a vested interest in pumping the stock up. Be very careful of sort of the hype of pre-approval. I mean, here's the biggest problem I see people. Basically, they're chasing approvals. So if you just sort of think about it and just look at everything we just looked at, tons of these stocks drop on approvals. I mean, the approval is the sell. The approval is the algorithmically programmed thing to see, hey, if we don't see a ton of people coming in this thing, we're going to destroy the stock because the approval was the top tick, right? So anyway, that all wraps up to just don't do what the masses tend to do on biotechs. Make your own mind. Again, I look at things. I look at balance sheet. I look at funding. I look at how much time can the company exist. Now, that only applies on the ones that are pre-approval. I mean, once you have approvals, they should have a long time frame of existence. There shouldn't be a big issue with them. But that's that's a different kind of evaluate. Like evaluating a Celgene and an Endo in names like that is different. Because you don't have to really worry about the long-term viability of the company anymore. You just have to worry about, are you buying the stock too high, too low, valuation versus other things. So, I mean, that's another thing too. You really have to evaluate biotechs just like you do tech. You have to evaluate them in two camps. One camp, you can kind of look at a lot of traditional things and say, hey, how's this company stack? How does Celgene stack up to Amgen? How does it stack up to Biogen? How does it stack up to Gilead? Well, with pre-IPO, with pre-drug approval companies, it's a whole different. You almost have to evaluate them like it's a game theory evaluation, option trading evaluation. You have to basically kind of look at things and, hey, what's your odds of success? What's your risk of loss? Line it up like that, because it just. There's not really metrics. The only metrics you have is hope. How much analysts like them. That's the other thing too. It's like you see a lot of analyst price targets on pre-approval things, and then post-approval. I mean, same thing. All the analyst price targets on ACAD were far higher before they ever had a drug approved. Now they have a drug approved, and the analyst price targets are very low. So, Jim, can you explain that to me?
Nope, that's why I bring you on.
Well, see, there you go. That's just right there. That just should tell you that, put it this way, find a way that works for you, instead of, piggybacking on, the poor analysis and the poor judgment of most others. I mean, this is a tough space. I mean, that's the other thing. I guess I'll close on this. If it's too hard for you, don't do it. I mean, just don't do it. I would, if you can't withstand a 30, 40, 50% or greater drawdown in a given biotech name, you should, I mean, I can almost say the same thing for tech. Tech, it's more like 25 to 50%. Biotech, it could be greater than 50%. But, if you can't withstand that, and or you're going to use a stop on any biotech, don't even do it. Don't even do it. And again, unless you're trading large size on high quality names that are less volatile. But even then, I mean, a Biogen can. I mean, you know, I do like Biogen a lot long term. Again, that's a stock I've had good success with over time. I once owned this, by the way, when it was. In fact, I own this for myself and clients when it was pre-Biogen IDEC. I think I owned both companies at one time. So I have a long history with that name. But yeah, I mean, that's, you just, basically you have to be able to take the risk and the loss to benefit from the upside. If you're not going to do it, just don't play. If you like tight stops and you like stuff that only moves 1% or 2%, and you know, something that's down 20 or 30% is going to cause you massive anxiety, just ignore it. Just don't do that stuff.
All right.
This is for cowboys. This area is for cowboys, and cowboys don't cry when they fall off their horses.
Nope, they get right back up on the horse.
That's right.
All right. I do have one more listener question, and I'm going to have to cut it off after this one, just for the listener's sake. They wanted to know if you could cover the EpiPen story and stocks related within the biotech, meaning Mylan, AMRX, Teva, and any other ones.
No, because that whole hubbub doesn't really interest me. Okay. Aside from if there would have been, I mean, first of all, I think isn't that kind of old news at this point? I mean, I know enough to know it was a big deal a while ago. I don't know, maybe it's still ongoing. I put it this way, none of those stocks have kind of entered my radar of being, if one of them enters my radar of being stupidly cheap with like a really good earnings and growth prospects, I might get interested in it. None of the stocks that I can think of right now in my universe of drug stocks that I'm interested in are involved in that space. So again, I always say I don't like to comment on things just to comment. If I know something, I know it, but if I don't, I'll leave it to somebody else. That EpiPen stuff isn't really my field of expertise at all.
And if I may interject, just one thing that I took away from our discussion, the importance of keeping your position size at a very tolerable risk, and so that usually means smaller size than what you're used to. So what might be a 1% position or whatever, you probably want to scale it back. What would you say? What would be a good basis to scale back? If you're looking at a tech stock and you're going to have a normal unit size or percentage of your portfolio, what would be the scale back equivalent in a biotech name?
Oh man, that's tough.
I know it's dependent.
A lot smaller. It very depends. I mean, there's certain names that, you know, I feel almost get to the point where I feel good enough where I'll break the rules.
Well, you see, your rules.
Well, here, let's just do this. Put it this way. I would say like something like an ACAT. Let's say a speculative tech stock. What's one of the more speculative tech stocks? I mean, again, a lot of them to me aren't that speculative because other people. Well,
let's just use Denali.
Okay, no, that's what I'm gonna do. So Redfin. Okay, Redfin to me is not that speculative because I'm so confident about the opportunity. But in the universe of tech stocks, Redfin would be pretty speculative, right? Okay, now let's look at Denali. It's a post-IPO biotech. So some people might say, hey, the risk of Redfin and the risk of Denali are roughly equivalent. Well, that's actually totally wrong. So I would say that my max position in Denali would at most be 1/5 the size of my max position in Redfin. It might even be smaller, by the way. But that would be kind of a way I would sort of line it up. Let's use Endo. Okay, so Endo is an established company, been around a long time, have earnings, have revenues, have lawsuits against them. But I mean, they're an established company. The odds of them disappearing are a lot lower than Denali. I'm going to say the same. The amount of Endo that I would be willing to have versus something like a Light or a Finisar or so. I'm not talking Qualcomm here. I'm not talking super high quality stable tech like Qualcomm, Apple, Google, etc. I'm talking. I'm gonna call it mid-tier tech. mid-tier risk tech. So maybe things like Hortonworks and Twitter and Sienna and Acacia type stuff. Same thing. Probably going to have about one, maybe in this case, maybe about a little bigger. I probably would be willing to own Endo about 1/3 the size of sort of what I would call a mid-tier risk tech name. So if that helps, that helps. That's just me though. I mean, you got to do what works for you. But I mean, I put some stuff out there. I mean, I'm not afraid to take some pretty tolerant risk parameters. And I mean, I'm way more risk averse in biotech. And again, I think the biggest thing is people think about it backwards. I'm not risk averse because I'm worried about the loss. Because my view is I've taken plenty of losses, and if I have some good picks, I can easily make up for the losses. What you can't make up for are long-term periods of underperformance, long-term periods of no performance. So in other words, I'm not so fearful of a loss. I'm fearful about opportunity cost. In other words, do I want a bunch of money tied up in Endo when I could buy Twitter? Especially when Twitter was cheaper. Do I want a bunch of money tied up in Denali when I could buy Finisar, which I literally almost know Finisar is going to work. I don't know when it's going to work. I don't know if it's going to be right to the magnitude I think I'm going to be right. But to me, Finisar is just like Micron. I pretty much knew it was going to work. I didn't know Micron was going to go to 50, but I knew it wasn't going to stop going up at 25, put it that way. So when I was buying Micron at 10, 12, 14 bucks, I kind of knew I had 2, 3x. I didn't know it was going to go 5x or 6x, but I knew it wasn't going to go to like 17 and quit going up once it started going up. And I knew I had very, very little risk of any permanent loss of capital in Micron. With Denali, I could, if I hold it long enough, I could lose it all in that particular investment, right? I don't think I'd lose it all in Endo. And Endo was pretty spooky, right? The fact that, when you buy a stock at 12 bucks and you think it really can't go much lower and it goes to 5, that's kind of spooky. But, but that's how stocks trade now. Stocks just trade weirdly. They trade more weirdly than they've ever traded.
All right. Well, I'll tell you what. Why don't we leave it there? I think that's a really good place to stop as far as giving us a really good snapshot of what you look at for biotech, giving us some good examples, and also putting into context what a good semblance of risk parameters might be as it relates to some of the other names that you talk about. So really good stuff.
I mean, look at Intercept. Okay, Intercept I jumped on. I'm going to close on this for a very. Intercept could go. Intercept. I mean, I could make a case the stock should go to materially new all-time highs. So in other words, let's just assume that the market had some semblance of intelligence at the prior high. So if again, if you're going to believe what most people believe about the market, that stocks are priced at where they're supposed to be priced at any given moment. Again, I don't believe that. But let's give that view an ounce of cred. If there was some validity to Intercept trading at 350 to 500 bucks, that means that the value of that pipeline was incredibly huge, right? Well, the Intercept's pipeline should be roughly the same, if not better, than it was at that point. And now they have revenues and possibly funding and things. So I mean, like I said, I'm just going to say that you don't need a lot of Intercept. If the thing ultimately goes to 300 or 500 or 1,000 or $2,000, you don't need a ton of it, right? You don't need a ton of it. If a stock is going to give you 2 and 3 and 4 and 5x type returns, you don't need a bunch of it. So I think people think we're wrong. They think, well, I'm not going to. I don't want a lot of this because I could lose a lot of money. And then, again, that's wise to think that way. But the other way to think is, most people probably think the opposite of what I just said. Well, wait, if this thing could go up 5x or 10x or 15x, then I want a lot of it. That's the wrong way to think about it. If it has that potential to go up a lot, you don't need a lot to make plenty of money. Put your money in other things, either that you can time better, that you can trade better, that you can rinse, repeat, that you can compound your money or they're safer, right? So in other words, you should have the bulk. I mean, this isn't advice. This is just, to me, this is sort of investing 101. You should have the bulk of your money. It's like that pyramid we all should have learned in finance, right? You have the bulk of your money in things that can't be taken away from you. So there's your bottom third of the pyramid. Then you have your next third of the pyramid. Okay, then you can have more money that's high risk, but still likely to not go to zero, but it's higher risk, more volatile. So you can put less money in things that probably aren't going to go disappear, but have higher risk of return, higher risk of loss. And then the smallest 1/3 of your capital probably should be devoted to things that are the most speculative, right? I think most people do the pyramid backwards. Don't you think, Jim? They put the most money in the bottom, the third of the most speculative things, then they put the next most money in the next most speculative stuff, and then they put the tiny little third of their money in their safe stuff. I don't know. That's what I saw a lot in my career working with other people.
Yeah, it's tough to tell. I don't know. I would like to think our listeners
well, I
are a
think
bit more
people have
savvier
learned a
than that.
lot after we've had so many crashes since '99. So we had '99, then we had 2008, then we had 2011, then we had 2016. So on and so on and so on. So maybe people have become a little bit a little smarter. I don't know. I see it. I used to always jokingly call it the backwards. I saw lots of people that had the backwards pyramid. By the way, the backwards pyramid is buying real estate on buying your third condo on your first two levered condos at the top of the market. That's a backwards pyramid, right? So I don't know. I think people still, at the end of the day, you need to do the right thing with the bulk of your money before you can speculate with a small part of your money.
All right. Well, hey, let's end it there.
That's where I'm going to end it.
All right. Well, there's your mic drop moment. All right, my man. Well, I'm sure we will talk later on this week, and we'll probably dive into some more of your meat and potatoes tech stocks. So let's take a break from there, and we'll pick back up later on in the week. Sound good?
Yeah, good enough. Thanks for having me.
All right. Thanks, Sean.
All right, bye.